All right, we've got it. So, hope everyone had a fantastic weekend and was able to stay warm with some of the frigid weather that we had. With that being said, my name is Sam. I'm one of the financial advisors here at Secured Retirements. Today's topic is tax planning, some hidden opportunities that are likely to expire. Probably a major topic on some folks' mind here with the new year turning over, looking at tax preparation, right? We're going to be getting those 1040s, W-2s here and probably the mail or email in the next couple weeks. So not only looking at that, but how we can better prepare ourselves over the next 5, 10, 15 plus years. So with that being said, we're going to get it jump started here. Just some disclosures that we need to go through to start. We're, of course, not attorneys. We can't give legal advice. We're not CPAs. I can't interpret tax law, but we're financial advisors. The information here is for opinions and, of course, for general information only. So what's at stake? As many of you have, if you're a current client or if you've been on these webinars before, we always talk a lot about the current tax rate environment that we're in. So the Tax Cuts and Jobs Act took effect here on January 1st, 2018. President Trump signed it into law. Currently, we're at 40 to 50 year lows for tax rates. This bill, though, they wrote in there that it's set to expire starting January 1st, 2026. So what that means for us is that we've got about a 4-year window here at minimum before we see tax rates revert back to what they were pre-Tax Cuts and Jobs Act. What that means for us is that we're more than likely looking at higher tax rates here in the near future. The other component of this is we know that Washington, in their infinite wisdom, they don't have to do anything in order for the current rates to sunset or expire. So basically, if nothing's done in between now and December 31st of 2025, we're going to then see some higher tax rates coming down the pipeline. So how does this impact you, and what are some of the changes that we saw from this? One of the major things that we saw was, of course, this temporary 20%, up to 20% deduction for pass-through income. A lot of our clients that we're dealing with, if you've got your own business, S corporations, partnerships, LLCs, even if potentially you've got some dividend earnings, right, from REITs, real estate investment trusts, you can use those and get up to a 20% deduction. A lot of times it's called a QBI on the 1040 or a qualified business income deduction. Number two, another thing that we saw was an increase in the standard deduction. So as many people probably know, in probably the last couple of years, unless you're doing a lot of charitable gifting, interest on the home, things like that, it's become very hard to itemize your deductions. Right? Our standard deduction in 2021 for a single taxpayer was at $12,550. Married couple filing jointly is $25,100. For 2022, we got a cost of a living adjustment on those. The standard for the single filer went up to $12,950. For married couples, it went up to $25,900. What we saw with this, though, is that obviously if you're taking the standard deduction, it's great. We get a higher deduction, therefore we have less taxable income. But for folks that were taking some of those itemized deductions, it may have hurt us a little bit. We've got the SALT tax here, state and local taxation, that's capped out at $10,000. As the third bullet point looks at here, we're no longer able to deduct interest on a home equity loan, whether or not you itemize. For folks that were doing a lot of charitable gifting, right, it's made it a lot tougher to get the tax deduction for it. Well, that's primarily with the charitable gifting, probably not the main reason we're doing for it, or hopefully not. It's also nice to get that tax deduction. So with that being said, it's created a little bit more challenges around maybe looking at grouping up some of our charitable giftings, looking at donor advised funds, qualified charitable distributions, things like that. But this is one of the things that with the new tax changes potentially coming down the pipeline, we also could see some changes to in the next couple of years. What we've seen a lot in the recent news, right, over the last going on 2 years now with COVID, but this rising debt. We're currently at I believe it's over 29 trillion. And we've seen a massive increase here, not only because of the COVID stimulus checks going out, but even before then, we had 10,000 baby boomers, retiring per day. We have Social Security, Medicare, Medicaid, these self-entitlement programs that we're trying to pay. And really the main point that we want to get across here is that at some point in time, we've got to find some ways to start paying for this debt. We can't just keep pumping money into the economy, not expecting to pay for it later on down the line. So that brings us to our next slide here, which is what can we do? What can we start to do now to hopefully plan ahead to better our tax situation in the future? A lot of folks, when you're talking, especially with financial advisors, they talk a lot about diversification, right? When it comes to your investments, should I buy a stock or a bond, a large company or small company? There's also tax diversification. And that's looking at not having all of your money in one basket or inside a qualified retirement account. A lot of us, I'm sure, and we see this every day with newer folks coming in, but most of us have traditionally saved most, if not all, of our money into our 401ks, right, through work, payroll deduction. We've done this on a pre-tax or tax-deferred basis, and we've let that money just continue to grow and sit inside the account. The trouble with that is that at some point in time, whether you have to take it out when you retire to supplement your income at age 72, when required minimum distributions have to start, or if your beneficiaries, kids, grandchildren, whoever it may be in the future takes that money, we're going to have to start paying some taxes on this. If you listen to our radio show, we talk a lot about this biggest lie, right, that's ever been told, and that's that we put money into our retirement accounts knowing that we're going to be in a higher income situation when we're working, as opposed to when we retire. But the fact of the matter is that with 40 to 50 year lows in tax rates currently, and what has happened here, not only over the last couple of years with COVID and the stimulus payments, but over the last 10 years with the debt, we're more than likely going to see much higher tax rates in the future than where we're at today. Some of these things can start to affect, Social Security, for instance. Currently, right now, the most that you can get taxed on your Social Security benefit is 85%, which means 15% is tax-free. If Social Security was our only income that was coming in, we know that it would be a completely tax-free asset. Right? We would never have to file another tax return again. But it's when we start adding other income into the picture, whether it's RMDs, 401k, IRA withdrawals, pensions, things like that, it's going to start to create that taxation for us. Another thing that we talk about pretty frequently here at Secured Retirements is looking at Medicare premiums. While it's not technically listed as a tax, we know that you are penalized if you make too much money and you're on Medicare. So you could have higher Medicare premiums in the future. The point being that is we need to start planning for this now, because if we continue to just wait and do the IRS plan, which is to let this money continue to grow, wait till 72 to take it out, that more than likely it's going to be coupled with higher tax rates. We're going to be paying a lot more in taxes than what we otherwise would. So there's a few things that we can look to do to diversify, right, when it comes to our tax situation. Now, a lot of folks, if you're in your 60s or even 70s, you may not have the ability to do this, or depending on where your income is at, but looking at saving in or contributing to a Roth IRA, right? That's one of the most common vehicles that the IRS gives us. If you're at a point where maybe your income is too high or you don't have the earned income to contribute, you can look at Roth conversions, something that we very frequently do, and with it being the beginning of the year, a very hot topic for us. But looking at taking some of your traditional IRA money, 401k money, willingly paying taxes on that now while we're at lower tax rates, and get that into a Roth IRA or a tax-free vehicle where you know it's going to grow tax-free in the future. Tax planning with a cash value life insurance, right? We a lot of times call this a Roth IRA on steroids. Works very similar to a Roth IRA in that it's tax-free, it grows tax-free. There's some other benefits with it as well, such as paying for long-term care, giving us some help with some medical expenses. And HSA is another one, a health savings account. It's a way to get money into an account that will help you pay for medical expenses, right? Make those tax-free. So with that being said, the main point today is now is as good a time as any, right? We've got these New Year's resolutions that we always come down to. And one of the big things that I think we can look at here with the start of the year is how do we start to better optimize our tax situation? The old adage, the best time to plant a tree is today. It's a perfect time to start looking at these tax situations. We know, again, that at a minimum, if Washington does nothing, we've got now a 4-year window with it turning to 2022 before tax rates go up. There was a lot of talk last year that we potentially could have seen higher tax rates sooner rather than later. They talked about higher income individuals potentially getting hit, step up in basis going away, capital gains increasing, things like that. None of that exactly came to fruition, but it is something that we always joke, tax law is written in pencil, so it could happen sooner rather than later. Point being, if you start planning for it now, you're going to be much better off in the future. I'm going to put an offer out here if you are on the webinar here today. It's a 5 hidden tax opportunities to take advantage of. So if you would like to get that, we will put that out for you and you can read it there. Upcoming events, we of course will be continuing to do these Monday webinars. Next week, we've got another advisor on staff here, Dylan Malberg, who will be doing it virtually. And then the week after, we will be doing our monthly lunch and learn. So whether or not you still want to catch that virtually on the webinar here, or if you want to come down to the office, we usually have a lunch that we'll provide as well. So we'll have that on Monday, January 24th. And of course, as always, whether you're a current client and you've been working with us for years, or if you're brand new to the program and first time looking in today, we're, of course, Secured Retirements. The team is always here for you. We would be more than happy to schedule a retirement analysis. You can do that by reaching out to us at the email below, the info@securedretirements.com, or if you call us directly at 952-460-3260. We would be more than happy to set up some time for you to speak with one of our financial advisors here to see if we can assist you. So again, feel free to email us info@securedretirements.com or give us a call 952-460-3260. With that being said, it was my pleasure to give the webinar here today. I hope everyone has a fantastic week ahead. Stay warm, and we'll see you here next week. Thank you.